Cast is now starting. All attendees are in listen-only mode.
Welcome to our 2018 webinar series. In case you didn't know, 2018 marks LLIS's 20th anniversary. So each webinar this year will involve the number 20. Included in each webinar are advisors' requests for specific information from the 2017 webinar surveys. So watch for a question that you may have submitted. Each webinar will last about 50 minutes, and you must be logged in for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's webinar is being recorded and will be posted on our website within a week in case you've missed it. And throughout 2018, loyal fans will receive 9 CFP CE credits, 1 for each month. And who knows, maybe one lucky viewer will have a chance to win a 20th anniversary gift from LLIS. Today's presenter is knowledgeable in a wide range of solutions here at LLIS. He's constantly monitoring the insurance and financial services industry to ensure your clients are getting the most up-to-date recommendations. He joined LLIS in 2003 with his CFP and MBA and has been leading LLIS as president and CEO since 2013. And here's Mark Maurer.
Thank you, Claudia. Thank you for everybody tuning in today. Fall is definitely in the air. There's a nice, nip here in Tampa. I think the low tonight is going to be in the 70s instead of the 80s. So, winter is coming. So thank you all for tuning in again. This actually celebrates our month of our 20th anniversary. And it's just been a lot of fun to work with all of you, all the advisors we worked with over years. And it's fun to be able to do these things too, to have the webinars, even if we don't necessarily get to speak to every one of you personally. We get feedback from the questions, and hopefully everybody learns a little something. So September is Life Insurance Awareness Month. And throughout the year, we're doing our 20 things in our webinars. So what are the top 20 reasons to have an individual life insurance policy? Number 1 is to provide money for loved ones when you die. Life insurance provides a death benefit when we pass away. This is sort of the fundamental reason that we do it. Now, lots of other things we get into details of how to structure it or different ideas, but really that comes down to it. If you don't have any loved ones who you want to have any money when you pass away, you don't need life insurance. But this is why we have life insurance, because there's a loss at our death of companionship, of parents, of income, all those other things that we want to make sure that if for the survivors, while there's lots of sadness and all those things, there's money there so that that's not another catastrophic loss to anyone. So we use it to replace lost income. Most of the time, that's the primary goal of individual life insurance, to replace lost income if an income earning spouse, partner, parent, what have you, dies before they're able to get to retirement, and there's that lost income. One of those things that we want to do with our income, a lot of us, is to help put our kids into college. Mine are in 5th grade and 3rd grade, and every time I look at those analyzers of saving for college, it makes me sweat. My heartbeat goes up a little bit. But I think we all want to, if we can, and have the wherewithal to, give our kids a bump up, because college today is what high school was probably 30 years ago. It's you almost need a college education to get entry-level jobs. So we want to be able to help our kids with that if we can. We want to be able to pay our mortgage. Probably for most people, that is the number one, the largest bill or payment they make every month. And so if something were to happen to one spouse, one partner, one parent, the ability to have money to pay off a mortgage or to be able to cover that $1,200, $1,500, $2,200 a month payment is a big part of that, not to mention having a house to live in. And of course, covering our income to get us to retirement. That is the number one goal of why we work. To be able to build that sort of financial house of cards, if you will. Sounds flimsy, but let's imagine they're really big, sturdy cards. Our income is what puts up all of those walls and puts a roof on it. If we don't have our income, we can't, it's hard to get to retirement age if you don't have any income to save for retirement. So, the goals are to get to retirement. So we look at, making sure that we have life insurance to replace our income, life insurance to be able to cover college expenses potentially for our kids, life insurance to be able to pay our mortgage, and then number 5, to be able to cover retirement, to make sure that in case we lose somebody dies prematurely, there's money there to fund retirement for the survivors. So how do we do that? What I like to look at is layering term policies. And so I'm going to compare just a regular term policy to a layered term policy. Let's take a look at Kurt. He's age 35. He's in good health. We're going to call him a preferred non-smoker rate class. And so if we take a look at his income today, future potential earnings, you might come up with a need of $2 million of life insurance today. So if he passed away today, $2 million of life insurance would help take care of his family if he passed away and wasn't able to work and get to retirement. He's 35. Your goals say he plans to work on till age 65. So we look at a 30-year term policy. So annual premium, $1,774. There's nothing wrong with that. That's a good way to go about this. But I like a second approach, and there's 2 things there. One, we try to tailor it to match to some of those other goals we have. Additionally, if we take this to the extreme example, he might need $2 million of life insurance today when he has potentially 30 years of income potential ahead of him. Does he still need $2 million of life insurance in 29 years when he has only 1 year of income left? Unless his last year of income in 29 years is he's making $2 million a year, then he has more than he needs at the end. So I like a term layering approach because it helps meet different goals and saves premium dollars. So Kurt, we look at a $1 million 15-year term policy that covers the period of time when his kids are small and possibly getting into college, doing a little bit of college savings. A 20-year term helps with finishing up any college, helps with getting most of the mortgage paid because they're working with you. He's on a pretty good clip to have that mortgage paid off. It's 5 years old, and we're hoping he'll get it paid off in the next 20 years, save 5 years of interest. And then 30 years, if none of those things happened, then we have that last $500,000 for those last 10 years to get to retirement, making up any retirement shortfall. So the idea here is that as he gets closer to retirement age and is alive, he's earned that income. He has income years behind him that he's used to save, to pay down mortgage, to pay for college. So as you get closer to retirement, you have fewer years of income replacement left, so you don't need as much life insurance down the road. Now, we don't do that just because it's complicated, which it's not all that complicated, but it's a little bit, more complicated than one straight term policy. We do it because it saves the client money. So in this case, Kurt's premium for still $2 million for the next 15 years, not all 30, but at least for the next 15 years when the kids are small, over time, initially it starts at $1,275 as a sum of annual premiums, and then in 15 years, that term premium drops off, and in 20 years, that term premium drops off. So over the course of time, he's going to be saving thousands of dollars by having a term layer that more closely matches his needs than the initial one, even though 100% there's nothing wrong with the initial $2 million 30-year term policy. One of the things that we look at with life insurance is how long do you need the term coverage? If we want to make sure that it's there till our kids are out of college, that might be a 20-year term policy. And that premium is going to be higher than a 10-year term policy. The reason we do the 20-year term is because we say, I know I need it for that long. Hopefully not longer, maybe a little bit less, but I'm okay with that. But I want to lock in the rate for the next 20 years. Because what happens if I just do a 10-year term? 10-year term is great. I know in 10 years my kids are going to be older, they'll be 10 years older, but they're still not self-sufficient. Maybe one's driving, but maybe they all aren't. So I had a much lower premium by using a 10-year term instead of a 20. But in 10 years, I have to do something. I may have to get a new 10-year term policy. Well, I'm 10 years older. My health may not be as good as it was. So I might pay a little bit more. My health might be terrible. I might be uninsurable. That's where it gets complicated. So we use that term period, even though it might be a little bit more, to do a 20 instead of a 10-year term policy, but we use it to cover that period of time when we want to make sure we're insured, and so we don't run into any risk of having a high risk potential of not being able to re-up our term policy. But you may have clients who did have a 20-year term need and got a 10-year term policy. And if their health is still good and they need new coverage for another 10 years, you can just go out and buy a new 10-year term policy. You can always do that. If health hasn't changed, or if health has declined, if health is not good, what is an option? Well, neat thing about term coverage is that there is a escape hatch, basically a second parachute, a ripcord that says, okay, you had a term policy, you are a preferred 35-year-old male or female. You got it for 10 years. In 10 years, you thought you were going to buy another 10-year term policy, but your health is not good anymore. There's this backup parachute called conversion that's built into the term policy that says we can exchange that term policy for a permanent policy. No health questions asked. That's it. Straightforward. I could have been preferred, or the client could have been preferred at age 35, had heart attacks, strokes, cancer, started smoking, started vaping, started flying ultralight gliders, can convert that term policy to a permanent policy at a preferred non-smoker rate class. That's the value of conversion. If health is still good, you can go out and get new policies. If health is not good, then conversion is amazingly valuable because there's no health questions. And you convert it the same rate class. And it converts at the current age. So if I got the policy when I was 35, wait 10 years, try to convert it in 10 years, I'll convert it at a preferred male non-smoker, assuming an age 45. So I have to use my current age, but I get to keep my original health classification. So the beauty of that is sort of like number 6, where we said make the term period match so you don't have to worry about insurability in case something changes, or maybe I might like some permanent coverage at some point in time, but it just doesn't fit the budget now. Having the conversion option built into that term policy is a nice backup feature. Another thing that I think probably everybody thinks about using life insurance for is paying for final expenses or burial. When you're talking to your clients and they're 35, they might understand term policies and why they need it. Probably they don't think about anything else except this, because this is what we all sort of personally think about. So that's an important part to this. So let's take a look at Mildred and sort of what she was thinking through all this, and why her advisor contacted us to help get a life insurance policy for her. She's a widow. She has one son, and her concern was not to leave him a lot of money, to leave him millions of dollars for estate taxes, estate planning, any of those things. Her number one goal was for that he would have enough money to be able to cover final expenses quickly and easily. And probably the quickest and easiest thing you can ever pay anything for with is going to be cash. And her concern was she wanted to make sure that he was going to have enough money to pay for all of these things without causing him any issues. So when we talked to her about a year and a half ago, she was 64 and she had a $101,000 whole life policy. And so we looked at a $101,000 no lapse guarantee universal life policy. So what this policy says is for certain premiums, it's going to guarantee that death benefit for her lifetime. And what we did was a 1035 exchange of her existing cash values plus 10 future premiums of $2,440 a year. And that's going to guarantee that $101,000 for her lifetime. The whole life policy she had, she was going to have to pay the $2,440 pretty much to age 95. So this was a way to get the same death benefit, but save her tens of thousands of dollars in premiums. So it did exactly what she wanted to do, and she knows that her son has the ability then from the life insurance to have money readily available to pay for a funeral, to pay for flights for any family members who may want to come out, pay current bills while the estate is settled, probably still have to pay utility bills, phone bills, all those things. And those are, she didn't want him to have any hardship, and basically to be able to say she leaves him whatever she has, and in her thinking it wasn't going to be much more than the house. And so then there's this life insurance that is there to give him some breathing room, some cash to get all of the estate figured out. Our ninth thing to talk about is to replace spouse's income. Might seem kind of obvious. If you have a spouse and two people working, then you would think, well, we need to replace both of their incomes for the family unit. And what I've found is just that sometimes with a two-income household, this can get a little contentious. One person might have a much higher income and therefore need larger life insurance. I've found sometimes that the person who doesn't have as high of an income can actually feel slighted by that. Feels like they're just as important to the household, and maybe they need that much life insurance. Can't really do that. It's going to be based on income. So not necessarily, I don't think most people, this is something that comes up when they're meeting with their family advisor, but just something that as you're talking about it, when one person needs 3 million and one needs $500,000, usually it doesn't have an issue, but sometimes there will be. The other thing to think about is a lot of couples sort of have my money, his or her money, and shared money. If you have, for example, two doctors making $1 million a year, you may not need to insure both of them for the same amount you would as if there was only one doctor in the household making $1 million a year. If one of the doctors making $1 million a year dies, the other doctor is still making $1 million a year. Granted, there's a loss of income. That other doctor may need to hire people and do things for kids. There is a big financial loss, but it's not nearly as catastrophic as if there's a stay-at-home spouse and only one doctor making $1 million. So if there are two partners who have good incomes, you may not need as much life insurance as you would if there's only one partner making an income. One thing that I can't stress enough is what I believe is the need for life insurance to replace the care that a stay-at-home parent provides. Stay at home is not a good word because probably any parents, you don't really stay at home. You're driving to soccer, you're driving to softball, you're driving to ballet, you're driving to lyrical dance, which I just learned was a thing this year. And apparently you need a whole different set of dance clothes for lyrical dance than you do for ballet dance. Things I didn't know. So, but you don't actually stay at home. You work at home. So you look at life insurance to replace the care and the things that a work-at-home parent provides for basically for free, that if that work-at-home parent wasn't there, you would have to hire other people to do. You know, probably most likely we think about either aftercare at school, a nanny, things like that. When we have kids, so this is where I talk about stay-at-home parents. How much? Well, for any given situation, you know best what somebody might need and might fit into their financial plan. From an insurance company's standpoint, most of the time they'll consider up to whatever the working spouse has for life insurance. They'll match that up to $1 million on a dollar-for-dollar basis. The working spouse, the employed outside the house spouse has $1 million of coverage. Most insurance companies will cover the work-at-home parent for up to $1 million. Over and above that, many times you're at a 50% of employed spouse partner. So they're all limits. There's no hard and fast rule. Most of the time, if we ask ourselves, is it reasonable? Then it's probably going to work and be reasonable. But those are things that, to make sure that the family unit would work, sometimes we think, well, one of the spouses or one of the partners is not employed, therefore there's no loss of income. True, there's no loss of income coming in, but you add a lot of expenses going out. And at the end of the day, those are almost the same things to the financial plan. A lot of you are going to have clients who have group life insurance. And a lot of the time it isn't portable. And I can't remember the last statistic I read about how often people change jobs. And if you go back to the 40s, most people lived and died at their original employer. And today we have 4 or 5, or I want to say something I read said 7, which seems high to me, but lots of different employers. And so any benefits you have with an employer usually is best when it's with that employer. And group or work life insurance through work normally isn't portable. And so having an individual life insurance policy that goes with you wherever you go is a good idea. So let's take a look at the group life insurance. And I just had somebody say that they lost sound. Can somebody tell me, can somebody on the answers just say, Mark, I hear you? Just so I can make sure everybody is hearing me. Okay, good, thank you. So group life insurance, while you're working, and this is where I'm talking about the life insurance that you or your employees or your clients pay for. So what the employee pays for. Usually employer provided life insurance, there's up to $50,000 that the employer just pays for. It's great. Over and above that, now where the employee starts to pay for some of it, it's usually group term life, and rates increase in 5-year increments. So usually you pay one rate from 30 to 35, pay another rate from 36 to 40, and those usually are 20 or 30% increases. They're pretty level for 5 years, and then sort of big steps. And while you're working for the employer is pretty much subsidizing some parts of those costs. But once you leave, the employer really doesn't have, like I said, employer stops subsidizing. not really any incentive to keep subsidizing life insurance for someone who's no longer working there. It's sort of like, if you leave an employer, they don't let you come in and keep drinking the coffee. You left, you need to kind of go on and drink coffee somewhere else. So when you leave that employer, a lot of times the only option may be to exchange that group term to permanent coverage. And so the premiums that you've been paying may be 5 times, 10 times higher. It's not just 1 or 2, it's usually that 5 or 10 times. So it's a really large increase if you need to keep the existing life insurance. You may not be able to take the full amount. The employer may allow you to buy 5 or 6 times income while you're there, but you may only be able to convert 1 or 2. There's lots of things that once you leave, there may be things available, but it's not going to necessarily be all that great. So having that individual life insurance that creates a floor, a base amount of coverage, and group is a nice plus, it's a nice benefit, but having that individual life insurance that goes with you no matter where you go is a good plan. So number 12, a reason to have individual life insurance is to buy a business partner's shares. And so I'm going to talk a little bit about buy-sell. And what is buy-sell? Well, there's really 2 parts to buy-sell. First is the contract. And this really has nothing to do with life insurance. But this is an agreement between partners that says if one partner dies, the surviving partner or partners agrees to buy back or to buy out the deceased partner's shares at some agreed upon price, formula, however it might work. Lots of variations in there, but it's a contract that says someone agrees to buy and someone agrees to sell at death, and there's usually some formula on how it's calculated. So you may have clients who have these in place. And if somebody passes away, the other people are on the hook to buy them out. If they have all the wherewithal and all the money in the world, you don't need life insurance because you just use your own money to buy out your surviving partner shares. Most people, especially sometimes the younger partners in a firm or the younger shareholders, don't have that much money just sitting around that they'd be able to use their own money to buy out, say, the elder partners 60, 70, 80% of a business. So you use life insurance as the funding mechanism. The buy-sell is a contract, it's completely separate, but you use life insurance as the funding vehicle that allows the surviving people to buy out the deceased partner's shares easily and quickly. And there's 2 main types, and I like to go through this just because I think it helps when we're having this discussion with clients. Cross-purchase is where an owner owns the policy on the other owners. So if there are 2 partners, each partner owns one life insurance policy on the other. This works out fantastically if the 2 business owners happen to be identical twins, because they'll pay the exact same rate for each other that they would for themselves. So they're identical twins. Each policy costs $1,000 a year, so they're each paying the exact same. That works out great. However, I have yet to work with any advisors or clients where the business owners are identical twins. And so most of the time you have some lopsidedness. And it usually works that the older partner has more of the business. Just probably makes sense. And so the younger partner owns the life insurance, owns a larger life insurance policy on an older person. So the younger person pays a much higher premium for the life insurance than the older partner pays on the younger partner. Now, we might just call that the price of being the new younger partner and coming into the firm. And that's okay. but it has this lopsidedness to it. What else can happen? If there are 3 owners, now we need 6 policies. Owner A needs to own a policy on owner B and on owner C. Owner B needs to own a policy on owner A and owner C. So you see how that works. If we have 4 owners, we need 12 policies. If we have 5 owners, we need 20 policies. So it gets really complicated really quickly if you may be adding partners along the way. So that's why there's the other type, which we call entity purchase. And the entity here is the business. The business is the owner, payer, and beneficiary of the life insurance policies. So that means there's 1 policy per owner. So that makes things much cleaner, especially if you have 4 or 5 partners. Maybe it's a law firm or even a financial planning firm where you tend to add partners, a partner every 2 or 3 years as they come on board. Entity purchase makes it much easier to manage. The other thing that helps is that all premiums then get lumped together as one expense. It's just part of the operations and it's just a line item and it's something that has to be paid, almost like the electric bill. And at the end of the year, is there money left over? Great. It just got lumped in with other expenses as compared to the cross purchase where each person really is paying their own premium. Of course, you can bonus people the premiums and things like that. But so this helps from that standpoint too. Still talking about the business, what about key person life insurance? Here's another good reason to have individual life insurance. So have that individual life insurance policy, again, owned by the business's owner, payer, beneficiary, and it's a policy on a key person, someone with specialized skills. Maybe they have specific rapport with clients, people who say, well, if Mark ever leaves, I'm not working with ABC firm, he's my guy. Things like that. May be the owner, but not necessarily. And most of the time, I would say when we're talking purely about key person, it's not the owner. The owner, a lot of times we build in some buy sell and might add a little key person into sort of the valuation. But usually when we talk about key person, it's usually not the owner. It's someone there at the firm who has some specialized skills that the owner may not be able to replicate. And so you have the life insurance and you use it to retain customers, use it to retain employees, you use it to replace that employee who's gone, calling headhunters, trying to find somebody who knows an awful lot about widgets, and recruit, finding that guy who knows just about as much about widgets as Mark did and being able to get him on board and giving him a signing bonus and paying for the movers to get him here, all those things. So that's what key person life insurance can do for the business. Keep that business continuity going. Now, what type of insurance can this be? Well, it can be term. Nothing wrong with that. Term is going to have the lowest premium. And from that standpoint, it's just an expense. There's life insurance as long as I keep paying the term premium, but there's not much there. Return of premium term. This sort of was really popular, I'd say about 8 or 9 years ago. And everybody said, oh, we've got return of premium term, return of premium term. But when you compare return of premium term to a regular term policy, it's more. So most people didn't really get the idea of it when regular term was less. But what's something with return of premium term? I can, as a business owner, say, I understand that I'm going to pay more than a regular term policy. But at the end of the term, at the end of the 20 years, 10 years, 15, actually I don't think there's any on 10, 15, 20, 30 years, if, employee Mark is still here after 20 years, he didn't die, didn't need to replace anybody, I get all my money back. And that's pretty good. But if he does die, I still have $1 million life insurance policy. So either way, I'll get more than what I've put in because he dies. And if he doesn't die, I'll at least get what I paid in back. So return of premium term in a business setting actually can make quite a bit of sense. Same thing with, because in that standpoint, you're looking at getting the money back. There are some cash values on it, so it's even like having an asset on the balance sheet. Same thing with low load universal life. Policy builds cash values from day one. There are no surrender charges, high cash values right away. So while money left the checking account, it's added to cash values of a life insurance policy on the insurance company balance sheets. So it's an asset. So it moves from one pocket to another. The nice thing about the low load universal life policy is that there's extra flexibility to the business if the key person leaves. And I'm going to touch on return of premium term here in a little bit, but return of premium term is a good deal if you keep it for all 20 years. If you keep it 19, it's okay. If you keep it 18, it's probably not that great. With the universal life policy, you have high cash values every year. And so then it adds extra flexibility. In case that employee leaves in 5 years, I can get most of my money back through the universal life policy. So some flexibility there. Question, what are the tax consequences of return of premium term? None, because the IRS says that the cost basis in a policy is equal to the premiums paid. So at the end of 20 years, if I paid in $2,000 a year, I get back $40,000. My cost basis is $40,000. So in that case, there's no taxable event. I'm really just getting exactly back what I paid in, so there's no taxable event. Question is, for the low load UL, who owns the cash value? The business. So for key person, the business is the owner, beneficiary, and payor. So that's why I said if the, say that employee leaves, then I don't need to do anything with it. The employee loses that benefit, but the employer can say, the employee is no longer here, I'll cash in the policy. When does a return of premium term make sense in an individual setting as opposed to a business setting? I will cover that here in just a second. I think it makes the most sense in a divorce situation. I'll touch on that here in a moment. So if the employee leaves, is this insurance portable? So initially, the employer owns a policy because the employer is the one at this point who has a loss. If my key employee leaves, I want money, or my key employee dies, I want death benefit there so I as the employer can go hire and find somebody else. If the employee leaves, and maybe it was after 25 years, got to retirement age, I as the employer could then give the life insurance policy to the employee. And if it's got $50,000 of cash value and $1 million death benefit, I can give the employee the policy with the $1 million death benefit and $50,000 of cash value. That $50,000 is considered taxable income to him. So it's portable if the business wants to give it to the employee, but for a key person, the business owns the life insurance policy. Great questions, thank you. All right, a lot of times we look at individual life insurance coverage for covering special needs children. And for anybody who's a parent, you know that there's lots of things we do for our kids for free that if we weren't here, we'd have to hire somebody to do and pay them to do it. So as parents, if there's one parent around, then that parent will still do all those things. But what if both parents are gone? And then we're not, with special needs children, we have more things to manage as compared to just simple school aftercare or a nanny, 3 hours a day after school. A lot more expenses, a lot more things that need to be managed. And anytime you have a lot more things and a lot more things that need to be managed, it's going to cost a lot more. So while there's one spouse there, Probably still all of that stuff is taken care of for quote unquote free. But if both parents are gone, who's going to take over the responsibility of that care? Is it a sibling? Well, they may have their own kids, their own jobs. How does that new care take into account all the new expenses that other family members might have? So lots of things to come into consideration there. So let's take a look at Steve and Lee. They'd met with their financial planner, and their daughter has special needs, and the financial advisor has talked with them about the fact that if something were to happen to both of them today, probably the need to be able to care for the daughter is about $750,000. And so we look at a second to die life insurance policy. While Steve or Lee is alive, they're going to care for the daughter. But if they're both gone, then there's money there for a sibling to be able to potentially manage the daughter's care, but not have to do it. And that $750,000 is going to be that funding mechanism to allow them to not be the care provider or caregiver, but to be able to be a care sort of manager. And so one consideration is the daughter's life expectancy shortened? Some special needs do have, children do tend to have a shortened life expectancy over average life expectancies. Some people may just need care, they need help, they need assistance, but their life expectancy isn't shortened over anyone else. So considerations when we start to talk about these types of policies are, how long do we think we're going to need the policy? Is there a chance that the child might predecease mom and dad? Things that as parents, it's even hard to say, but things to think about when we start doing some of this planning. So for a $750,000, first thing we looked at was a no lapse guarantee survivorship policy. They'll pay $642 a month for the rest of their lives. And the $750,000 death benefit is guaranteed for the rest of their lives. This policy is going to have no cash value in 20 years. It's working almost like a term policy, like a lifetime second to die policy. Somebody asked, wouldn't it be best to set up a special needs trust and that trust would be the beneficiary? Yes, that's probably true. So yeah, I didn't necessarily mean that the daughter would be the beneficiary, but that the daughter might be the trustee of the special needs trust. And again, any more than that, now we're getting into sort of attorney responsibilities, and that's one thing I'm not. So thank you for clarifying that if I wasn't clear on that. So that's one type of policy. Second, another no lapse guarantee policy. This policy for $912 a month will guarantee the coverage for their lifetimes. But this one has $74,000 of cash value in 20 years. So in case something happened, the daughter predeceases parents, the need is no longer there, then there's some cash value that Steve and Lee can use to fund, sort of recoup some of the premiums they've paid to add to their retirement savings. Third option, if we don't use, third option, $925 a month. This policy is designed to have some cash values. So highest premium, but in 20 years may have almost $300,000 a year, or $300,000 in cash value. So we can design these policies to say almost what is the most likely outcome, or how do we need to have, what did I say before, the extra parachute, that backup parachute. What sort of backup parachute do we need here? Paying higher premium but having cash value in case something happens and parents outlive the daughter? Or are we going with lowest premiums to have the smallest hit on their spending today, because the daughter is probably going to outlive them, but just may need some assistance every year. Sometimes life insurance is required for a divorce. And we've found that sometimes people need to put this in place after the fact. Sometimes they need to have it beforehand. They have to keep it in place. So we'll review policies sometimes that clients have that need to have life insurance. Sometimes it gets a little tricky in that one of the divorced spouses may not make a lot of money, but is required to hold X amount of life insurance. And that can get kind of tricky with underwriting sometimes, justifying why they need that much life insurance. And a divorce decree will do wonders in that. But sometimes it's going to be required for divorce. Again, saying I have group insurance isn't going to be a great fit, because what if I change employers? I may not be able to keep that life insurance. So if it's required for a divorce, I want to keep it and keep going and have it myself. So that's where here I said consider return of premium term. Here's Tom, he's age 45, a $750,000 20-year term for a preferred non-smoker would be about $1,090 a year. He's got to keep $750 for the next 20 years. So he can pay $1,090 per year, and over 20 years, he'll have put out $21,000, assuming he doesn't die. Or we can look at return of premium term. Here's why I said return of premium term didn't get as much traction as you think it might have, because the premium was $35.55, and our other one was about $1,000. So it's a lot more to get all of your money back. But in this situation, it may be worth it, because at the end of 20 years, Tom could have paid out $20,000 in total for life insurance if he had the regular term, or he could have paid out and get nothing back at the end of 20 years if he didn't die, or he could have paid out $71,000 over 20 years and get back $71,000. And as somebody asked, what's the tax consequences? None, because he's getting back 100% of his premium. As you can see there, this is why somebody asked, why is the maybe term instead of UL? For the first few years, return of premium term has little to no cash value. It's great at year 20, you get 100% of your money back. In year 5, you got about, you paid in 15,000 and you get 3, so you get about 1/5 of what you'd paid in back. So this is great for those sorts of situations. The low load universal life would have been great too, but here's an idea sometimes where if I have to keep it a certain amount of time, I'm going to pay more, or the client's going to pay more, or somebody's going to pay more, but at the end of it, they get all of their money back. Why individual life insurance? Because coverage is pretty affordable. Remember where I talked about group coverage and it increases at 20 and 30% clips? Well, it really can. When you get to be in your 40s and 50s, group life insurance is very expensive if you're in good health. And so here's Mike, age 35, $1 million 20-year term. He's going to pay $37 a month. For a lot of us, that doesn't necessarily mean anything, but it's about 9 Starbucks mocha frappuccino thingies. Fancy coffee isn't your thing. I think I'm the only person who goes into Starbucks and says I'd like a black coffee, and they kind of look at you funny. It's about 4 draft beers. That's what it costs a month, so that Mike can have $1 million of life insurance to protect his family over the next 20 years. Michelle, women pay less for life insurance than men. About 8 fancy coffees or about 5 beers. You know what? That's not bad. Another reason to look at individual life insurance, pension max. So what is pension max? The longer the time goes on, fewer people have pensions. But you may have clients who have this decision coming up soon. They're going to be offered a number of different payouts, but primary 2. 1, you can take X amount per month, and this will pay for as long as you live. Or you can get Y per month, and it will pay a lower amount for as long as you or your spouse lives. So there's hidden life insurance there. If I can get $5,000 a month on just me, or $4,000 a month, because at my death, my spouse will continue to get $4,000. There's hidden life insurance there. At my death, somebody will still continue to get some money. So we use individual life insurance to ask a question, can we get life insurance on the pensioner to provide life insurance that would be an equivalent benefit to a surviving spouse? So at the nut and bolts of it, it cost in my scenario $1,000 a month to be able to provide a spouse $4,000 a month of income if something happened to a pensioner. Can we use life insurance to get equivalent death benefit to do the same thing for less than that $1,000 a month? There's a lot of details and number crunching that goes into this beyond the scope of this of today, but here's ideas of when it might work. When the retiree is healthy, the person has to buy life insurance, and so for this to work, he has to be in better, or she has to be in better than average health. You also want a healthy spouse. If the spouse is likely to predecease the pensioner, then you may want to take the life only, knowing that the pensioner is going to outlive the spouse and not take the reduction. I say not too small. If the difference in pension is $300 or $400 a month, the amount of life insurance needed are very small, and life insurance policies tend to be pretty inefficient below the $100,000 mark. So unless there's a fairly, a good amount of difference in the pension monthly benefit, then it's small policies and they're just not that efficient. 3 to 6 months before retirement. If you call me on a Monday and say my client's retiring on Friday and he has to make the election on Friday, I can do all the number crunching in the world and say it's a great idea to do pension max, but we won't have time to get new policies in place. So that's why I say at least 3 months to have time to get the underwriting done, to put life insurance policies in place, but usually not more than 6. Why? Well, in my scenario, we're asking, the goal is to buy life insurance for less than $1,000 a month. Most people don't want to pay the $1,000 a month for very long until they start having the $5,000 a month coming in the other pocket. So looking 2 or 3 years out isn't going to make sense because things can change additionally. No COLA or inflation on the pension benefits. The reason that the way I do pension max works is because we layer some low cost term for a few years and then some permanent. If there's an inflation, if the amount of benefits keeps going up, then we need almost all permanent coverage, and it's just not going to be cost efficient. Following into that is no government plans. Government plans usually have the inflation. They also tend not to be priced by insurance companies or using sound financial planning. If they're wrong on their assumptions, they just raise taxes. You use individual life insurance policies to be able to leave a legacy to loved ones. And this can be factored into those final benefits, but a lot of people want to leave their loved ones something at their death. And at about October, I think 26th, we have a policy with Columbus Life. It's our Advisor Plus policy with a no lapse guarantee rider. And that particular rider is going to be discontinued at the end of October. Why is this important? Because it works really well for clients who want to do short pay or single pay life insurance plans. And you can see here that right now the rider is just neat. If we do a single premium or a 1035 exchange, the death benefit is about 20% higher than the next comparable. On a 10 pay with annual gifting, $421,000 of death benefit as compared to $309,000. So if we've looked at one of these policies for you or your clients, we can still be able to get applications in the next month, and that's fine. But this particular no lapse guarantee rider that you can see there, how great it is going to be put on the shelf, from what I've been told, until interest rates start to come backup. Another way to use individual life insurance is to leave a legacy to your favorite nonprofit educational foundation. And there's really two ways to consider this. Who should own it? If the client owns a policy and names a charity as the beneficiary, that's fine. There's no deduction of the premiums during life because the client owns it. The estate gets a charitable deduction at death of the life insurance proceeds. If you're in a taxable estate situation, then that's something that you could probably use, but there's no tax deduction during life. There's a deduction, the estate gets a charitable deduction at death. So what we probably want to do is have charitable deductions now. The way to do that is to have the charity own the policy, but we gave up policy control. So if I still own the policy, I don't get to deduct anything during life. My estate gets a tax deduction, but I retain control of the policy. I can change the beneficiary, I can change the owner, I can give it to somebody else, I can cancel the policy, so I retain ownership. If the charity owns the policy, now this is where probably people think of how it would work. I send the charity the premiums, and I get to deduct that premium. Or I get to deduct that. So if the premiums are $10,000 a year, I write a check to the charity and I get to deduct $10,000 a year. It's a charitable deduction. Then the charity takes the $10,000 I wrote, pays it into the life insurance policy. What can't the client do at that point? The client can't change the beneficiary of the policy, can't change the owner. The client does not have control of that policy anymore. So if the client decides that they don't like what that charity is doing now, they can't change the policy to a different charity. They can't get it back. What control they do retain is they don't have to pay any other premiums. They don't have to continue to make charitable deductions, don't have to make donations to that charity anymore. And so the charity now has a policy that they either need to fund themselves, may just let cancel, let lapse. So that's what control the client still has. Sort of like giving your kids the keys to the car. You can give them the control of the car, but at some point you take back the keys. All of this is designed for peace of mind. Lots of things in life that we can worry about. A lot of them are beyond our control. We never know when something's going to happen. But by having the life insurance, individual life insurance in place now, if any of those events happen where we need the life insurance for this or for that, and the client passes away, you can't bring somebody back, but you can prevent a catastrophic financial loss. So thank you, everybody. I had some good questions. I enjoyed it. So just to wrap up, I will be at the XYPN Live next week. It's hard to believe that's already next week. And at the NAPFA Fall Conference in October and the ACP Annual Conference in Miami in November. And I'll try to have some cooler weather for everybody there in November. If you haven't worked with us before, haven't listened to one of the webinars before, we like to say what are the top 10 things that make LLIS different. One of them is our free monthly webinars like you just listened to. And so we'll have an October, November, and December. We are not competition to fee-only financial advisors. We're a partner. Our only clients are fee-only advisors, and we do our best to save advisors time and your clients money. We do a lot of pre-underwriting to avoid surprises along the way when clients apply for life insurance or we look at different options. We have lots of tools for advisors and clients there on our website. We are proud sponsors of a number of different fee-only financial planning groups. We're a NAPFA resource partner, the NAPFA Genesis sponsor. We're, like I said, exhibiting at the XY Planning Network next week, ACP in November. Jerry and Joe were at the Garrett conference in July, I think it was. And so you're going to see us there and be able to hear us again. We have specialists in different solutions for life insurance, disability, long-term care, annuities, and hybrids. And I get this question a lot: what do you all do to help our clients and their policies down the road? We have a full policyholder service team, and they help manage clients' policies in the future with our APE systems, and that's an advanced premium email, so that clients don't ever, to the best of our ability, we're letting clients know they're having a premium come due, and they have the ability to know that those premiums are coming and be able to pay them in case they happen to be on vacation coming up soon, something like that. And our note systems, our notification of term expiration. Remember the client with the 10-year term, he may need it for 20 years instead of 10. And so we're working with advisors and clients to let them know that the term policy is coming to the end of the expiration. Are there ideas of what to do? And we designed our new portal for advisors and clients. We call her Alice. And so it's been almost a year, and lots of ways for you and your clients to have information right at their fingertips. And goal is to make it where there's lots of things easy for you as advisors to access one place. And I see a few other questions, and I see one or two that are sort of long, and I don't know that I'll be able to do it online here, but I'll be able to email back everybody here in the next few days to your questions. Oops. Scrolled over the wrong screen. Yes, I have 3 screens, believe it or not. Oh, some of these are popping up here. Oh, sorry, one of these was for somebody who's already left, and see a few others. And so, like I said, the couple that are here are sort of long ones, so I'll get back with you shortly. And thank you, everybody. I think we're right at 5 o'clock. So again, thank you to everybody for tuning in, and look forward to seeing some of you at XYPN next week, and having everybody tune in for the next webinar in October. Thank you all very much.